Some companies return billions of dollars to their shareholders through dividends, and other companies nothing at all, even if they make the same profit. At first glance, this can seem confusing or even appear to be a massive red flag. But once you understand what dividends actually mean, you'll start to see the stock market in a whole new way. This video will give you a simple framework to evaluate dividend stocks so that you do not fall into a dividend yield trap. Now, there are 5 conditions that a company usually needs to meet before paying a dividend is a good idea. And the first condition is foundational to why businesses even start in the first place. The whole point of a business is to maximize profits and then put those profits in the hands of the owner, to put as much cash in the hands of the owner as possible. Now, a dividend is just one vehicle to put cash in the owner's hands. There are other vehicles, and we will discuss those later in the video. But for the sake of this condition, a company must have profits. Now, since we're talking about publicly traded companies, the owners of the company are the shareholders. So that's us. So the whole point is to put cash in our hands, and a company cannot pay a dividend unless it is consistently profitable. The second condition relies on a company's liquidity. A company can have lots of profits, but it can still be strapped for cash. And without cash, a company can't pay a dividend. So how is that possible? One example is a dentist office. A dentist office can be very capital intensive. The owners of the dentist office must put a lot of cash into buying equipment, and the cost of that equipment doesn't get counted against the profits, at least not all of it, because the dental equipment is considered an asset. Only the depreciation is counted against the profit. So a company could have lots of profit, but they still had to use all their cash to buy dental equipment. Thus, they're strapped for cash. They can't afford to pay a dividend, even though they're very profitable on paper. Another example is because of debt payments. So a company can have interest that they pay every single year, and the interest is counted against their profits, but eventually they have to pay back all the principal. And when they pay the principal, that cash that goes into the principal, it doesn't reduce their profits for the year, but they got to have that cash to pay the principal when it becomes due. Another way that companies can do this is they could pay a little bit of principal every single year. And once again, if they have the cash, just barely enough to pay the principal, they're not going to have enough cash left over to pay the dividend, even though they have lots of profits on paper. So for a company to be able to pay a dividend, they have to have lots of cash, lots of free cash flow. For the third condition, let's look at some of the other vehicles for returning cash into the hands of the owners, because dividends are not the only way. If we zoom out, there's 2 major categories. Number 1 is putting cash directly in the hands of the owners. We know that as the dividend. And the second way is to increase the value of the company. That is known as capital gains. The owner can extract value from their company by increasing its value and then selling a few shares to put cash in the owner's hand. And functionally, the dividend and the capital gains are very similar. For instance, if I could choose between increasing the value of my company by 2%, but paying no dividend that year, versus my company stays the same value, but pays a 1% dividend, I would choose the first option every day of the week, because at the end of the day, as the owner, I want to get more cash in my hand, the most cash as possible. So option 1 does that for me. Now, how does a company increase its value? How do we maximize capital gains? Well, let's check out this article by McKinsey & Co. McKinsey analyzed 2,200 large global companies, and they revealed the importance of monitoring both economic profit and revenue growth. In other words, the 2 things that were most heavily correlated to increasing the value of the company was economic profit growth and revenue growth. And we can see that as we scale up in these quintiles, so this is quintile 1, companies that increased their economic profit by the least, versus companies that increased their economic profit by the most. And then the same is down here on the revenue growth, starting with the lowest quintile, increasing their revenue the least and increasing their revenue the most. We can see that shareholders received the most benefit when companies increased their economic profit and their revenue. And that seems pretty straightforward. It seems pretty obvious. So let's look at the components of the value of a company. Generally speaking, and this is simplifying it quite a bit, but a company's value is equal to its net assets, like its assets minus its liabilities, and its future earnings growth potential. So if we look at 2 different companies here, they both have the same exact assets and liabilities. That's equal. That's the blue section here. But one company has very little economic growth prospect and the other company has lots of growth potential, then company 2 is going to be worth more than company number 1. Now let's look at what happens when a company actually pays a dividend. In this graph, we're looking at the same company, but in 3 different scenarios. Now, we still have the same, starting off, the same exact assets minus liabilities. It equals 10, but this time I broke out the cash portion. I separated the cash from the rest of the assets and liabilities. So in total, it's equal to 10, but the cash is equal to 2, and then the remaining is equal to 8. And then once again, we still have 10 in future earnings. Okay. So when the company pays a dividend, you can see that the cash is reduced, which reduces its assets minus its liabilities. So the value of the company, even though it has the same future earnings potential, the value of the company goes down proportionally to the amount of the dividend that's paid, because the dividend is cash leaving the company. So the owner gets paid through cash. Now, the owner could do the same exact thing by just selling a few shares and reducing his value that way. But in this case, we're looking at what happens when the company pays cash. Now, sometimes when a company loses cash, it also hurts its other category, this future earnings category. So in this case, the company loses cash. Now it has less cash that it can invest into its future earnings, and now its future earnings actually goes down. So even though the company only paid out 1 unit of cash, in this case, they've lost 2 units of value. So this is the condition that companies have to consider before they pay a dividend. Sometimes dropping their cash can hurt their future growth prospects. So let's look at a concrete example of this. This visual here shows a single market contained by this oval. And in this market, there is only one Walmart. Now, this Walmart has its lines out the door. There's so much demand in this community for this Walmart that it can't possibly serve all its customers. So the Walmart pools its cash and it invests in putting in a second Walmart. Now, this second Walmart, it also has its lines out the door. There's still tons of opportunity for growth here. So it still doesn't make sense for this Walmart to pay a dividend. They want to put in yet a third Walmart. Now, at this point, if all the Walmarts are at capacity, but their lines are no longer out the door, if they put in a fourth Walmart, it might not make sense. This fourth Walmart might start cannibalizing customers from the other 3 Walmarts. And instead of going from $3,000 a day to $4,000, now each individual Walmart is making less money. Now you're going from $3,000 to $3,200, and yet you had to invest tons of money into that fourth Walmart. You have lots of new expenses associated with that fourth Walmart. So in this situation, instead of going from 3 to 4 Walmarts, it might make sense for that Walmart to start paying a dividend. But when the Walmart only had 2 locations in that area, they would not want to pay a dividend and sacrifice all of that future growth, because at the end of the day, growing is what's most important. Putting the most cash in the hands of the owners as possible, whether that's a dividend or through capital gains, it does not matter which. In other words, a company generally doesn't start paying a dividend until it's reached a certain level of maturity. It has consistent profits and consistent cash flow, but its growth prospects are somewhat reduced. The fourth condition for a company paying a dividend is mainly applicable to publicly traded companies where there are millions of shareholders and the interests of all of them need to be juggled. So generally speaking, when somebody invests in a dividend company, they care about the dividend. And if the company were to cut the dividend or reduce the dividend, then a huge chunk of the shareholders would be pissed and they would punish the company by selling their shares and going investing in another dividend company. As a result, companies have a really hard time reducing or cutting their dividend because of the backlash of a large chunk of their shareholders. If a large chunk of shareholders start selling, that's going to push the value of the company down. And the remaining shareholders don't want to see that. So when a company starts paying a dividend, they're sending a signal to investors. And this signal could be read as a good thing or a bad thing, depending on what you're looking for. But a good way to read this is that the company is confident that they are going to have consistent profits and enough cash flow to pay a dividend for a long time and probably raise that dividend in the future. Now, the bad spin on this is that the company is saying, I don't have as many growth prospects as I did in the future. Because if a company has tons of growth prospects, they don't want to put their cash into paying dividends. They want to use that cash to grow the company and give more return to the shareholders greater than the amount of the dividend. Even though all these previous conditions could be met, we've got a mature company with tons of cash, zero debt, it still might not make sense to pay a dividend. There might still be a better way. This fifth condition has to do with the company's share price. When a company is confident that its share price is too low, and this could be because the share price dropped in value, or it could be because the company has more growth prospects than the market is giving them credit for. But if a company is confident that its share price is too low, there's a better way to give profit to the shareholders. And that is for the company to buy back its own shares instead of giving those dividends out to the shareholders and then letting the shareholders buy the shares. It's more tax efficient for the company to just buy the shares on its own. Because when you receive a dividend, that is a taxable event. And depending on your income level at the time, you might have to pay up to 20% of that dividend in tax. Whereas if the company just uses its cash to buy back its own shares, what that does is it reduces the pool of total shares. So before, if I owned 1% of the company, if the company were to buy back half of its shares, that means there's only half the shares outstanding. Suddenly my 1% is doubled. Now I own 2% of the company. It's like saying I pay for a single slice of pizza and I'm expecting this same size pizza to have 10 slices, but then the day comes and they only cut 5 slices. Now all 5 slices are twice the size of a 10 slice pizza, so I benefit with my 1 slice. Shareholders have the same dynamic. So if a company is able to buy back its shares, it is another way to return the same value as the dividend to its shareholders, except without the tax. Now, on the flip side, if a company is kind of pricey, if it's a very popular company, lots of people want to invest in it, there's high demand for that company, there's a good chance the company could be slightly overvalued and buying back its own shares might not make sense. Maybe as a shareholder, I would prefer that I receive that cash and I can invest in other companies. Like I don't want to sell out, but I don't want to increase my holding in this company anymore. I would prefer for the dividends to just come into my pocket and I can invest that money as I please. This fifth condition is a little bit more niche, but if a company's shares are undervalued, I would much prefer that company to do share buybacks instead of paying me dividends and making me pay taxes on those dividends. It's also a strong signal to shareholders. When a company is doing heavy share buybacks, this company is saying, hey, we think our shares are undervalued. We are saying it's a good investment to invest in our company, and they're saying they're confident in the future growth of the company. Whereas on the other hand, if a company is expensive, it's a very popular company, I'd prefer that they just pay the dividend in that case. So if a company's shares are considered expensive or overvalued, then I would prefer the dividend. These 5 conditions, when taken together, tells me a lot about the state of a company that decides to pay a dividend, but they still don't tell me if it's a good idea to invest in a dividend company. Sometimes focusing on dividends can cost me years on my portfolio, tens of thousands or hundreds of thousands of dollars. To see how I decide when is the right time to focus on dividends, check out the next video. Hope to see you there.